Welcome to Illuminati Silver. We tell you the truth about silver. Today is Monday the 18th of May 2020, and yesterday we published a video entitled Why Serious Investors Advisors Now Recommend Gold. And on Saturday our Gold and Silver Weekly update for the week ending the 15th of May, where we highlighted that last week gold rose $40 an ounce to $1,743 and silver rose $1.14 to $16.66. And that we also forecast that this week we were expecting even higher prices. Certainly initially, though, a temporary pullback was possible. And that since mid-March, the environment began to change quite significantly, with investment houses, banks and a whole array of advisors now seriously suggesting that gold should be the investment of choice. We also mentioned that there would be a modest but nevertheless important change in the gold to silver ratio downwards, and today this is exactly what we've witnessed. Also quite impressively, equity markets too have risen quite considerably. But first to gold and silver. From the opening, gold began strongly, and at one point rose to $1,765. But at the time of writing, which is 2013 GMT plus 1, its price has fallen back to $1,734. Silver, on the other hand, has performed considerably stronger, rising not only above that important resistance level of $17, but peaking at $17.57 at one point. Currently, it's $17.10, some 43 cents higher than its closing price of Friday. This now means that the gold to silver ratio has fallen from its recent low on Friday of 104.6 to 1 to 101.4 to 1. So what has happened today to cause such moves? Well, frankly, renewed confidence in the equity markets truly hit gold quite hard, not only preventing another strong rise, but causing its price to fall back. Now, one need not be too concerned about this, as corrections can indeed prove beneficial, though short-term uncertainty and hesitation may cap gains for a little while gold leaves weaker hands and move into stronger ones, and those who have decided to take profits have fulfilled their contracts. The fact that the dollar index has fallen reinforces this view, as one would have expected gold prices to rise with a weaker dollar. The dollar index is down 0.75 points and stands at 99.65. Now, from a technical point of view, the main trend is up according to the daily swing chart, and so is the minor trend. The short-term range is from $1,788 to $1,666, and the main range is from $1,788 to $1,576. Its retracement zone at $1,682 to $1,657 is major support. Now, tomorrow's trading will be important in that if gold remains below $1,756, we may be entering a bearish closing price reversal top, thereby causing gold to retrace further to $1,725 within the next couple of days, and possibly it could actually dip below 1,700. However, we see this as positive, ironically, providing, of course, gold does not fall below the figures mentioned earlier, in other words, below the sort of 1666 level. Now, looking at silver, our weekend bullish statement appeared somewhat prophetic. The return to work by many across Europe and the United States led traders to believe that the industrial demand for silver could be back on, and this, coinciding with gold's rally, really acted as a significant boost for the silver price, at least on opening and the first couple hours of trading. However, coupled with this was the announcement of positive trials with a potential vaccine provided by Moderna, plus the Fed chair promising to support Wall Street almost regardless of the cost, curtailed both gold and silver rise as investors began again to view equities as a more lucrative investment source. Now, technically, silver has support at $17 and extremely strong support at $16. And any rise up to and beyond $17.50 again, and if it holds, will quickly see the price move to $18. That said, as with gold, there may now be a temporary pause in view of what is happening with equities short term, which we shall now take a brief look at. The Dow Jones Index is currently up 961 points at 24,646. The S&P 500 is up 93 points at 2,957, and the Nasdaq is up 239 points at 9,253. The Euro Stoxx 50 closed up 141 points at 2,911. The FTSE 100 closed up 248 points at 6,048. The DAX index closed up 593 points at 11,058, and the CAC 40 index closed up 220 points at 4,490. And we're expecting the Asian markets overnight to rise similarly. Now, it's interesting in that we were tempted to undertake a video this morning when we saw what was happening to gold and silver prices, especially with their rather quick initial rise. But we held off as some of our contacts told us to expect a slight reversal, as some positive news for the equity markets was about to be announced. And this is what has happened, and has certainly taken the shine off gold particularly, and slightly off silver's quite significant gain. You see, we're going through volatile times, and the slightest glimpse of recovery can be positive for equities, and equally the slightest bad news, then the opposite occurs. And generally, not in totality, but generally, you can expect gold particularly to move in the opposite direction to what's happening with equity markets, and silver generally to follow gold, though, as we have said on the weekly update, the relationship between the gold and silver ratio has certainly got out of hand, and some catching up was required. Not as much as the pumpers would have you believe, but at least a modest correction. Now, there is little economic data per se until the end of the week, and we should expect a little pullback or consolidation for a couple of days before that data is announced. Now, that said, we have no desire to alter what we predicted on Saturday in our weekly update, and for those who perhaps may regard any pullback as a sign of a major downward trend, we just draw your attention to the following article published by Bloomberg today, which is so representative of what is happening globally and should at least put your minds at rest that your gold investment may be safer than perhaps you could fear. So let's just take a look at that Bloomberg article. Bloomberg article dated May 18, 2020. Bank of England debate about negative interest rates is stepping up a gear. The Bank of England's debate over negative interest rates stepped up a gear on Monday, with one policy maker saying they've had a positive effect elsewhere. Silvano Tenreiro's comments follow those of the central bank's chief economist, Andy Haldane, who said in an interview published over the weekend that sub-zero rates are something officials need to be looking at. Tenreiro said the Bank of England would have to examine certain aspects of negative rates when it comes to protecting the financial system, but is also not ruling them out. The scale of the economic shock has prompted investors to bet on more major central banks lowering borrowing costs below zero. Even if that fails to stimulate demand battered by the pandemic, it will keep the lid on interest rates at a time when governments are increasingly turning to debt markets to finance massive bailouts. Europe's experience shows negative rates, quote, have had a positive effect in the sense of having a fairly powerful transmission to real activity, unquote, Tenreiro said Monday. There are some considerations that are more specific to the UK and will need to be worked out, including the effect on some financial institutions, implementation, communication, and so on. The European Central Bank and others have already cut rates below zero, but has refrained from reducing its benchmark rate during the crisis, relying mainly on quantitative easing. Investors are now betting the Bank of England will take borrowing costs into negative territory in December. Before Tenreiro's comments, they saw such a move in February. For now, everything is on the table for us, she said on an online seminar hosted by the London School of Economics. while the idea seems to be gaining traction inside the United Kingdom central bank, at least as a longer-term option, there's also been some mixed messaging. Governor Andrew Bailey said last week that while negative rates weren't being contemplated at the moment, it's important not to rule anything out forever. The benchmark rate now stands at 0.1%, and taking it negative could prove difficult for banks, he said, and potentially make it difficult to influence borrowing costs across the country, or across the economy. It sounds as though the Bank of England has far from made up its mind on the issue, Alan Monks at JP Morgan said in a note published before Tenray Rose spoke. End of article. So, to conclude, let us be confident about one thing. Both the Bank of England and Federal Reserve have regarded negative rates as truly a last resort, partially because of the intricacies and unique features of certain sectors of their financial systems, which are not necessarily common elsewhere. But if the Bank of England is now seriously considering it, and getting the idea out there, at least for discussion, then after Jerome Powell's comments yesterday, promising unlimited support for the equity markets, or should I say Wall Street, you can bet that despite protestations to the contrary, they will be considering it as well. What do you think? Do share your thoughts. Thank you so much for listening, and if you haven't already done so, please subscribe to our channel and press the bell sign so that you're notified of our videos as and when they are published. Not forgetting that we update our Richard and Greg channel every few days, and there will be a new update appearing on that channel tomorrow. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.